asset. Together, we call it as capitalization. Okay, that means for the whole period of time, how much you have used that particular asset. That refers to your capitalization. Okay, so in simple, we can say this capitalization, it's an what do you say, outlay in the sense blueprint of an asset on which we are representing in our balance sheet, okay, rather than an expense on your income statement. Okay, so basically this capitalization is an quantitative assessment, okay, of a form of your capital structure where you are showing it in your balance sheet. Okay,
Okay, ma'am.
now next is my this thing moving, screen moving. Can you able to see my next PPT?
No, ma'am.
It's okay. Now, okay.
Okay, ma'am.
Now, next coming towards types of capitalization. Basically, you have got two types of capitalization. What are those? The first is your accounting and the second is your finance. Okay. Accounting is nothing but this is your principle. Okay. This is the principle wherein we are requiring your companies to record your expenses in the same accounting period for a particular period in which whatever the expenses, whatever the incomes that you have incurred for a particular period of time. Okay, no doubt, like whatever the assets that you are calculating, these assets are benefit to your business for more than one accounting period. It's not like whatever the assets that you are using only for a particular duration you are using and then you are just neglecting it off. It's not like that. Okay, as long as the life of that particular asset is there, you are using it, that particular thing will be there in your company. So for that particular period of time, you will be calculating the accounting period of a particular, what do you say, asset. Okay, so you have got so many fixed assets like your buildings. Okay, for example, you are using a particular office building. After would you just dismantle the building of it? Would you dismantle the building of your organization once it is used over a period of time? No, right? As long as that particular building is giving you the life, okay, till that particular period you are just using that particular fixed asset. Okay, so the cost of items that are recorded on your ledger or the cost that was incurred on your historical cost, okay, all these are referred to your capitalized, not expenses. You will not treat it as your expenses. So capital assets are not fully expenses but your earnings, okay, for which it is giving you over a period of accounting time. Okay, so company, basically it depends on the type of property or type of plant or the type of equipment that you are using in your organization. That refers to your accounting period. Now, next coming towards your finance. What do you mean by finance? Capitalization can refer to the book value cost of capital, which is the sum of a company's long-term debt, stock, and retained earning. Okay. So here, what you are going to calculate, whatever the book value of your asset is there, that is the market value. Okay, so this market value is dependent on the price of your company stock. Okay, market capitalization is nothing but this is the number of outstanding shares that is multiplied by your share price. Okay, for example, if you have a total number of shares as 1 billion, okay, and the stock price is $10, okay, then what will be the capitalization? It will be $10 billion. 1 billion multiplied by $10. So ultimately, the market capitalization will be 10 billion. So the companies with a high market capitalization, these are referred to as large caps. Okay, large cap is a concept wherein you are just multiplying your share price to the total number of shares. Okay, this is what you are calculating in your finance capital. Now, next coming towards your sources of capitalization. Basically, you have got your four sources of capitalization. Okay, share capital, reserves and surplus, long term loans, short term loans, and trade credit. Now, one by one, we'll just come into it. Okay, first coming towards your share capital. What do you mean by share capital? What do you mean by share capital? The capital which is that you are incurring from your shares is nothing but your share capital, right? So here we are not only using the term capitalization for your companies or for your partnership purpose, but even for sole proprietorship also you can take the concept of your share market into your consideration. So this narrow interpretation is more popular since you have got a specific meaning of it. So the capitalization and the capital structure. Okay, both are similar to both are similar to each other, but there is a very minute difference. I mean, you can use it interchangeably. Okay, that is the proportion of your various securities that are issued to raise the total amount of your money, the total amount of your cash. That is referred to as your capitalization. Reserves and surplus are nothing but that you will be incurring from your share capital. There might be some loans which go on for long term period. That goes for long term debts. Okay. So as long as it is there, you just have to go on and fulfilling and go on for repaying the interest of it. Next is short-term loans. Short-term loans less than 1 year or so that are referred to as short-term loans. So from wherever, whichever banking institution you are just taking a short-term loan, you have to pay the interest for it. Now, next coming towards your theories of capitalization. This is one of the important question from the point of your external. Okay, theories of capitalization. This is a must question. You can expect it. Okay, so just make a star mark over there.
Okay, ma'am.
Coming towards your theory of capitalization, you have two theories: cost theory of capitalization and earning theory of capitalization. Coming towards cost theory of capitalization. According to this theory, the amount of capitalization is equal to the total cost incurred in setting of a firm as a going concern. Therefore, the estimation of capital requirements of a newly promoted firm is based on the total initial outlays for setting up of a firm. Now, what does your cost theory of capitalization says? The theory of this says whatever the cost of fixed assets are there, for example, your land, your building, your plant and machinery, that cost you are just uh, calculating as per your working capital. Okay, because working capital is a very important concept to carry on your business operation. So the expenses that are required for promotion or that are required for establishing a business, that comes under your this cost capital theory. Okay, I'll give you a small example. For example, the cost theory of capitalization is basically useful for those firms in which you have fixed capital more than your earnings. Okay, so for such things, we are using this theory, that is cost theory of capitalization, where the fixed capital is more than your earnings in regular. For example, your construction. Sometimes it may happen your public utility concern. Okay, so for these particular thing, you are going with cost theory of capitalization. And this theory is very easy to understand, and also it will help us to know the capitalization that is required in order to start a new business. Okay, and also it helps the promoters to know how much amount of capital has to be raised in order to start up a new business. Okay. Now, next coming towards earning theory of capitalization. What does this theory tells you? According to this theory, the amount of capitalization of a firm is determined by its earning capacity. That means in our previous theory, what we have seen, whatever the fixed assets are there and whatever our incomes are there, if it is more than that, then we will be using cost theory. Whereas earning theory is something based on your earning capacity. Okay, the capital of the firm is determined. Okay, that
Okay.
means the worth of a company is not measured by the capital. Whatever the capital that you have, it is not decided by the worth of that. But whatever the earnings that you are making out of your productive assets used, okay, with respect to that, you are calculating your earning theory of capitalization. And this particular theory is used where a new firm, a new company will have to estimate its annual future earnings. Okay, or normal earnings also you can say, which are very common in a particular company. Okay, so under those circumstances, we are using this equity capital theory.
Earning.
Now, sorry, yes, earning theory. Now, next coming towards overcapitalization and undercapitalization. You have these two terms, overcapitalization and undercapitalization. So, first, let us understand what do you mean by overcapitalization. Before we move on to this overcapitalization and undercapitalization, have you ever heard about actual capitalization and fair capitalization? Actual capitalization is nothing but this particular concept we calculate by adding the paid up value of whatever the shares that you have, whatever the debentures you have, whatever the reserves or surplus you have. When you arrived at a particular location, at that time, we are going to calculate your actual capitalization. And actual capitalization are calculated with respect to the above two theories. Okay, for example, in case if a company actual capitalization is more than its fair capitalization, okay, then it is said to be over capitalized. Okay, if actual capitalization is more than fair capitalization, then we call it as a company over capitalized. If it is less than the fair capitalization, then the company is said to be under capitalized.
Okay.
Okay. See, overcapitalization means existence of excess capital as compared to the level of activity and requirements. If it is there, then the company is said to be overcapitalized. Now, what are the effects of overcapitalization? Basically, it depends on company, it depends on your shareholders, it depends on your consumers, and also it depends on the society or the people who are working at large. Okay. So, in simple terms, for example, if a company is earning a profit of 50,000, okay, a company is earning a profit of 50,000 and the normal return rate is 10%. Okay.
Yes,
That
ma'am.
means the amount of shares and debentures should be 50,000 of 10% will be
Fi-
5
fi-
lakhs,
5 lakhs.
right? So the
Yes,
amount of shares and debentures is 5 lakhs.
five
That
lakhs.
means if the amount of shares and debentures issued by a particular company is more than 5 lakhs, then it is said to be overcapitalized,
Yes.
right? If it
Yes.
is
Okay.
less than 5 lakhs, then it is called undercapitalized. Okay. So the
Yes.
term overcapitalization is something that should not be taken to your excess fund. That means there can be a situation where the company may not be having sufficient funds. Okay. When the company is not having more funds and still if it is lying at a low earning capacity, then the result will be overcapitalization, right?
Yes. Yes, ma'am.
Yes, ma'am.
So we are going to see the concept of overcapitalization first on company, then on shareholders, then on consumers, and then on society at large. So first coming towards on company. Okay. So the real value of the business and the earning capacity. It reduces the adverse effect of your market value of your shares. How? For example, there might be temporary means like lower amount of depreciation. Okay. There might be temporary means like maintenance charge. If these are followed to improve the earnings, that ultimately it adverses the situation further. Okay. If the shares of your company are getting depreciated, okay, or the life of the asset is getting depreciated, what will happen? At that time, the situation goes worsened. Okay, so this is how it happens in company. Coming towards shareholders, how the concept of overcapitalization affects their, this is the worst affected class on shareholders. Okay, the shares which are held by what do you say? The shares which are held by your tangible assets because of the reduced market value, these shares become non-transferable. Okay, if there is no value of an asset, would you be able to sell in the market?
No.
You cannot do it. That means those shares are non-transferable, or sometimes you just have to avoid it, or are required to be transferred at extremely very low value. Okay,
Yes.
so this ultimately affects the value of your shares. Okay. If the fixed asset value is getting on depreciated, is going at a very lower level, at that time, it ultimately reduces the value of your shares. Now, how the concept of overcapitalization affects on your consumers? To overcome the situation of your overcapitalization and how to improve the earnings of the company, here you have to increase the selling price of your shares at a more price. Okay, particularly in monopoly market, what will happen? At some period of time, you just have to increase the value of your share. Okay, when you are increasing, what will happen? The quality of the product may also get affected. That means your consumers get affected. If you're getting a price of a particular product at a regular price, suddenly if it is getting increased, what will happen? It
Market
affects
will down.
the demand purchase of the consumer, right?
Yes.
Ultimately, it affects the marketing
Yes.
value of the product, right? So this is
Yes.
also one of the concern when you are going with overcapitalization on your consumers. Next, on society at large. Okay, sometimes it may happen the increasing selling prices or the reduced quality. Okay, it cannot be move on continuous basis. That means at the same time you just cannot increase the value and you cannot reduce the quality. Either you have to increase the selling price of your product or else you have to reduce the quality, but at the same time you just can't go with these two, right? So a
Yes.
situation like this means losing the backing of the shareholders. You're using the value of your shareholders as well as you're reducing the buying behavior or the purchasing behavior of the consumers. So when you are reducing it, ultimately what will happen? As a result, the company is dragged towards winding it up or shutting it down at a very adverse level. Okay, in your industrial production, or sometimes it leads to what do you say, firing of employees or unemployment, or wherein unrest among the workers. Okay, that means you are not giving a kind of a break to your workers. So these are some of the adverse condition that goes on with your overcapitalization towards a general public. Okay, now when there are certain things where you cannot reduce it, ultimately you'll be having some remedies available, right? So what are the remedies that are available to overcome the situation of overcapitalization? Sometimes it may happen to reduce the debt by repaying them. That means the debt should be repaid at a particular own earnings of the company. Okay, whatever the earnings that you are getting from the company, from there itself, if you are able to repay the debts, up to some extent, you are able to overcome the situation of overcapitalization. And next is to redeem the, what do you say, value of your preference shares if it is going at a very high rate. Okay, with this also you are able to overcome. Sometimes it may happen the person who is holding the debentures, okay, they may be able to accept new debentures which carry a very lower rate of interest. Okay, or else increasing the number of your equity shares. Okay, this also have to be done only after the shareholders get into your confidence level. Okay, so there are some remedies where you can avoid the situation of over capitalization. Now next is under capitalization. Undercapitalization is a situation where the profit earned are exceptionally high, but the capital employed is relatively small. That means here the capital, whatever that you are earning, okay, that is less than your profits that you have earned. At that time, that refers to your undercapitalization. So a firm is said to be undercapitalized when profits earned are exceptionally high and the value of long-term asset is higher than the capital raised. Okay, so in simple words, here whatever the profits that you're earning are exceptionally high. Okay, and for example, if a company is earning a profit of 1 lakh, okay, and expected rate of return is 10%. What is the amount of capitalization? 1 lakh into 10% is 10 lakhs,
10 lakhs.
right? For
Yes.
example, if a firm is raising only 8 lakhs, okay, if a
Yes.
firm is raising only 8 lakhs, the actual earnings shall be 12.5% more than the expected rate, because as per our expectation it should be 10 lakhs, but we are getting only 8 lakhs. Okay, so in this particular case, instead of rate of earnings as 10%, it will move on to 12.5% or 13%, you can say, where the expected rate is very high. Okay, so such a situation we call it as undercapitalization. And for this undercapitalization also you have got certain reasons. What are those? How it affects on your firm, how it affects on your shareholders, and how it affects on your society. Okay, coming towards first effect on your firm. Okay, the concept of undercapitalization, it ultimately increases or decreases the credit. What will happen in undercapitalization? Does
Yes.
it increases your credit worthiness or it decreases your credit worthiness?
Increases.
Increases the credit worthiness. Okay, how it is able to increase the credit worthiness? Due to the high rate of earnings. Okay,
Yes.
due to the
Yes.
high rate of earnings, we are able to increase the credit worthiness. When we are getting higher earnings rate, okay, that means we are trying to encourage the outside people to enter into our field and increase the competition of our product. Okay, so the employees at this particular instance, they may demand high salaries. Okay, when a company is going at a very high level, ultimately the
Yes,
expectation
ma'am.
of the employees also gets increased,
Yes.
right? So they may
Yes.
demand high salaries, they may have high wages. Okay, if at all, if we are not doing it, what will happen? That leads to dissatisfaction. Okay,
Yes.
this is how
Yes.
the concept of undercapitalization affects your company. Now next, how does the concept of undercapitalization affect your shareholders? Due to the high earnings of the firm, okay, when we are getting high earnings, ultimately we have to pay high dividends to your shareholders, right?
Yes.
The
Yes.
shareholders will be receiving higher dividends from their point of sight, right? So the shareholders here, they also avail capital gains because the market value of the firm is, the market value of the share is getting increased. Okay, and they will have a very great value, and they will be at very ease in getting loans against the security of their shares,
Yes,
right?
ma'am.
So this is how it affects your shareholders. How it affects on your society? This ultimately affects your investment climate because the consumers here, they feel very exploited since the profits on the firm are high, because you're just, I mean, changing their minds to go on for high salaries, to go on for high wages at a certain point of time. If you're getting low earnings, will you be able to give the same amount of salary, same wages to your company, or same flexibility to your employees? You will
No.
not be able to give it. Okay,
Yes. Yes.
so when you're not able to give it, what will happen? It ultimately exploits your employees because
Yes.
you're not aiming the profits at a very high level and you're not paying to that particular level where you got high profits. So that ultimately affects your society. It may lead to labor unrest. Sometimes it may lead to labor strike. Okay, if they demand for higher wages, or if you're not able to increase their benefits or not at all accepting their demands. Okay, at that time they may go on for strike. Okay, and here also, in order to avoid the concept of undercapitalization, we have got certain remedies. What are the certain remedies? If you are increasing the number of equity shares by revising the value of asset, what will happen? This will decrease your rate of earnings. Okay, sometimes the retained earnings, whatever that you are getting, whatever that you are issuing, okay, as a form of your dividends to your shareholders, this will reduce the rate of your earnings per share without reducing the total earning of your company. Okay, sometimes it may happen due to insufficiency of capital. Most shares or most debentures, they may be issued to the public. Okay, so this is also one of the remedy that you can avoid the concept of the undercapitalization.
Undercapitalization.
Okay, so with this we have completed our block one. Okay, then you have factors determining capital structure, that is cost of capital. You have degree of capital, trade on equity, and then government policies. Fine.
19th, January 19th.
Now, next coming towards,
Madam,
yes,
share this block PPT, madam.
yeah, I'll share this block PPT.
Block. And block tomorrow it will be over or
No, no, I'm sharing it now.
all from block 1 or block 2.
Hmm. Yes. So with this, we have completed your block one, okay, in which we had all 5 units till your concept of your capitalization. Now, next coming towards your block two, okay, in your block two, you have the concept of your, basically we are discussing about financial markets, okay, in which we have your capital market, you have your
Money market.
money market. Okay, let me just read out the topics for you. So I'll just try to complete today 2 units of your block two.
Yes, ma'am.
Okay. Yes, capital market, money market, then foreign capital and collaboration. Okay, so as much as possible, I'll just try to cover it in today's class. So in this block two, first you have about financial markets. I'll just give you a basic introduction of financial markets. Then we'll move on to your capital market and then money market. Okay. Now,
Yes, ma'am.
coming towards your financial market. As you can see the definition, a financial market is a marketplace where buyers and sellers they trade financial instruments such as stocks, bonds, currencies, and derivatives. Investors, companies, and governments they raise capital, try to manage risk, and transfer assets over here. Okay. So, in simple words, financial market is nothing but where we are trying to sell your financial instruments. What are your financial instruments? It's nothing but your stock, your bond, your currencies, your derivatives, whatever that is traded. That particular place we call it as a financial instrument. Okay. So, here in this particular financial market, we are just trying to trade your instruments. Okay, when we are trying to trade our instrument, that means we are trying to transfer our assets over here. Okay, We are just trying to transfer our assets from one party to the other party by selling it. That particular place, you call it as your financial market. Okay. So in this financial market, again, you have two types of market. That is primary market and secondary market. Okay. And in your financial market, you have capital market and then you have money market. Are you getting?
Yes, ma'am.
Yes, ma'am. So the markets which can be classified into primary market are nothing but your financial institutions, are nothing but the traders where trading takes place. Okay. Trader trading takes place means there are some new securities. You heard about IPOs, initial public offering. IPOs are being sold. This is similar to your shares. Okay, IPOs are traded. That means IPOs are nothing. We are just trying to sell from one party to the other party. This particular IPO, we are just trying to allow investors to manage their financial risk just to generate your profits. Okay, so financial markets basically it is governed by your regulatory bodies. You heard about SEBI, SEBI, Security Exchange Branch of India. You heard about SEC, Security and Exchange Commission. These are nothing but these are regulatory bodies wherein we are trying to sell our securities, okay? Sell our financial instruments, okay?
Okay.
These
Okay.
organizations, what do they try to do? They try to protect your investors. They try to maintain fair and transparent practice. That means no such biasing will be done. Okay, no such fraud will be done. These are some regulatory bodies where they try to maintain fair and transparent policy. Okay, coming towards your secondary market. Okay, secondary market, it deals with your securities, such as your security of deposit. Okay, you just deposit some kind of papers. Okay, so there are some large financial markets in the world. Do you heard about this New York Stock Exchange? New York Stock Exchange, your what do you say, Bombay Stock Exchange, BSE, NYSE.
MSc.
Then you have your what do you say, London Stock Exchange, Tokyo Stock Exchange, Nasdaq. All these are your secondary markets, wherein they try to deal with securities,
Oh,
okay, in lieu to deposit of their certificates. And all these markets, they have their own time zones because these are all international markets. Okay. So basically, these markets will try to allow your investors in your financial markets to trade round the clock service. That is 24 by 7. These securities, they just go on for trading their securities. Okay. So this is about basic introduction of your financial market. Now, next coming towards your capital market. What do you mean by capital market? Capital market are those who where savings and investment are channeled between suppliers and those in need. Suppliers are people or institution with capital to lend or invest. Okay, so in simple, capital markets are nothing but wherein we are dealing with savings and investment. That means these savings and investment are distributed between suppliers and your buyers. Okay, are those in need means buyers only. So ultimately, suppliers are the people or your banking institution from where we are trying to invest our money or from where we are just trying to borrow the money from there. Okay, so they typically includes your banks and investors. So the one who seek capital in the market are business, or it could be a government agencies, or it could be an individual. Okay, so the basic common capital market is your stock market and your bond market. Okay, these two market, that is the stock market and bond market, they try to improve your transactional efficiency by bringing your suppliers together. Okay, wherein they try to exchange your securities. Okay, so this the term the capital market is one wherein we are going with digital spaces as well. In person also you can just sell your security, or else digitally also you can sell it with respect to various entities. Okay. So the venues that include your stock market, your bond market, or else your foreign exchange markets. Okay. These are referred to as your stocking exchange securities building. Okay. So in your capital markets, basically you have your suppliers and you have the users who utilizes the funds from different banking institutions. So the users of the funds who distribute their capital. Okay, it could be they could be using these funds for their personal use, that is for your house construction or for your home purpose, or sometimes they go on for vehicle purchases, or sometimes they go on for non-financial companies, or else your infrastructure investment, or else on your operating expenses. Okay, so the capital markets is nothing but we are trying to sell your financial products such as your equities, your debt securities to a particular owner. Okay, so that particular owner will get the ownership to issue the companies in their share market. Okay, again, this capital market is divided into two. What are those? Primary market and secondary market. Primary market is where new equity, stock, and new bond issues are sold to investors. And secondary market, which trade existing securities. Okay, so in primary market, we are just trying to sell your new equity stock and your bond issues. Whereas in secondary market, existing security. Okay, whatever the certificate that you have, that particular certificate you are just depositing and then you are taking a loan against it. That referred to as your secondary market. Now, next coming towards your primary and your secondary market. Okay, primary market is nothing but it engages in primary market where when it publicly sells new stock or bonds for the first time, that you referred it as your initial public offering. Okay, IPO stands for initial public offering. Okay, this market sometimes referred to as new issue market. That means here the company will try to offer the securities, or they hire an underwriting firm, that is third party you can say, where investors they try to purchase security on the primary capital market. So the firm that review it and the firm that creates outlining or the blueprint of the price and other details of the security to be issued, that is referred to as your primary market. So whatever the issues that are there in your primary market, all these issues are subject to strict regulation. Okay, if any problem exists over there, the companies they can file statements within their SEBI or within SEC, that is Security and Exchange Commission, or there might be some other security agencies, and they have to wait until their filings are approved before they go on for public offering. So unless and until all the issues are cleared, you cannot go for further what do you say next stage. Okay, so here small investors, they are often unable to buy securities in the primary market because the company and the bankers which are present, they want to sell all the available securities for only short period to meet the required volume. Okay, so to so that they can focus on the market sale to for large investment who can buy more securities at once. So the marketing people who are there to sell your shares to investors, they can go with your what do you say trade shows, or they can go for road shows to promote a product in which the investment bankers and the company they will have to meet with their potential investors, and they try to convince them for the value of the security that is being issued to them. So there are some promotional strategies wherein the marketing people can just go ahead with it. Coming towards the next, that is your secondary market. Secondary market includes venues overseen by regulatory body like the SEC, that is Security Exchange Commission, where these previously issued securities are traded between investors. And also the secondary market has two categories, the auction and the dealer markets. Okay. So apart from this SEC, even you can include your NYSE also, that is New York Stock Exchange, NASDAQ also. These are also some of the examples of your secondary market wherein you are trying to exchange your securities to the previously that are issued one, okay, between your investors. Okay. Now, as I already told you, the secondary market has two categories, the auction and the dealer market. Auction is nothing but this is home to the open system where buyers and sellers they come together at one location and they announce the prices at which they are willing to buy and sell their security. Okay. Best example is your New York Stock Exchange. Okay. This is one such example wherein the people they will try to trade with the help of electronic network, that is online. They just go on with New York Stock Exchange, they just go on with online selling of their shares in dealer markets. So many small investors they try to trade through your dealer market. Okay. Are you getting? So your primary market, I mean, wherein you are just going with road shows, the promotion that goes on with road shows or trade show, you can say, or else you can just go into face to face. Okay. Whereas in secondary market, you are using a kind of digital network in order to sell your shares. Okay. The best example is your New York Stock Exchange. Now, next is what is the need and importance for your primary market? Okay, that means what is the necessity of your primary market? Okay, in your capital market. Okay, the primary market plays an important role in the economy as it provides companies and governments with a way to raise funds and investors with an opportunity to invest in new securities. Okay, basically what happened, this primary market, you can call it as new issue market. Okay, wherein it refers to the market where securities, okay, such as your stocks, your bonds, your debentures, these are created and these are issued for the first time by companies or government in order to raise their capital. Okay, so in finance, we refer to the market where new securities are brought and they are sold for the first time. That is referred to as your primary market. Okay, so in this primary market, we are just trying to sell your securities directly to investors who purchase them for the first time. Okay, so in this financial market, we are just trying to go on for setting up of a business where different types of bonds, different types of securities are traded at a very lower rate of transaction. Okay, so to ensure that that a capitalist economy functions well, the financial market is necessary to help in resource allocation. You just have to check it whether proper resource allocation is being done, and also they have to create a kind of a liquidity for their business. Okay, if it is going on, then the financial market they have to ensure the free flow of capital between investing as well as collecting money from various parties. Okay, that has to be done in a very smooth manner or mobilized properly. Okay, sometimes it may happen the financial markets they also help us in smooth functioning of economies. Okay, by liquidity for their business enterprise. Okay, so the vital importance of your market, it enforces the transparency of your business to maintain at appropriate levels. Okay, there might be some macroeconomic factors like your tax. Okay, tax it goes on changing because you don't have a particular constant value of it, and there are some other aspects, okay, like your market value of your share or the market value of a particular asset that holds an indicative value. Okay, it these are not constant, it goes on changing, like how you have your New York Stock Exchange. This is one of the biggest stock market in the world, and this financial market record trades worth trillions of dollars every day. There is no constant price for these what is the instruments. It goes on changing on daily basis. So as an institution, we have to just involve for the flow of investment, the flow of savings, okay, wherein it try to help uh, to facilitate the growth of your funds, and also it helps to in production of your goods and services, okay, because ultimately at the end of the day you have to contribute to the demand of your receivers, you have to contribute to the demand of your investors, and even the economy of your country. Okay, so based on different institutions that offer your financial holdings, like your mutual funds, you have your insurance schemes, you have your pension schemes. All these are combined with your financial markets just to offer bonds and shares to contribute to your nation's economic growth. For this purpose, you are just going up with the concept of your primary market. Okay. Now, next you have your types of financial market. Okay. You have got nearly 6 types of financial market: stock market, over the counter market, bond market, money market, derivative market, foreign exchange market. These are the 6 types of financial market. Coming towards the first, that is stock market. What will happen in this type of market? In this type of market, the organization or the firm, they make a listing of its shares. Okay, they make a listing of shares which traders and investors they wish to buy and they wish to sell. Okay, so stock marketing, they make use of your IPO. This is first time offering, that we call it as initial public offering. So in your stock market, it allows your companies to increase their capital. Okay, it allows the company to trade your shares to your investors who wish to buy and who wish to sell for the first time. Okay, if they are doing it, so that particular market we call it as stock market. So in simple word, stock market is nothing but we are just trying to buy and sell your stocks, or wherein you are just trying to trade it, okay, by going in on for the first time. Next is over the counter market. Over the counter market is something, this is a decentralized market. What do you mean by decentralized? You have the concept of centralization and decentralization. Okay, what do you mean by centralization? Centralization is something which is there in your account. That means you have got some hold of it, wherein you can control it. Decentralization is something which is going out of your control. Okay, wherein some segregations takes place. If at all, if any company is suddenly trying to increase its price, you cannot just go beyond to that how you are able to increase the price. That is ultimately their point of view. Okay, so in such a case, you do not have any authorization in your hands to just sue over to that company. That is referred to as decentralization. Okay, so in the over-counter market, over-counter market is a decentralized market wherein you will not have proper or fixed geographical locations. And even you will not have a price constant over here. The trade is directly done between two parties. Okay, so here the most stock trading is done through exchange only, wherein you will be having your agent, your broker, some third party may be there. So you will not have your hold under the over counter markets. As and when you want, you are able to increase or decrease the price of your shares. Now next is your bond market. Okay, this is a kind of a security wherein we are just trying to allow your investors to borrow money from the lender only for a certain duration of time. Okay, so when we are lending a money, ultimately we have to go on with a fixed interest. This is nothing but this is your bond. So the here the bonds are issued just to aid your financial projects, either to your state government or to your central government, or sometimes to your what do you say, public agencies or your municipal corporations. So here the bonds are usually issued in the forms of bills and notes. Okay, that particular market we call it as bond market. Okay, Now, next coming towards your money market. What do you mean by a money market? Money market is nothing but this is a kind of a market wherein we are trying to trade in holdings with other with higher liquidities, and also it is sometimes relatively safer also when compared to the other three markets. Okay, this money market is safer wherein you are trying to trade your holdings with higher liquidity. Okay, and apart from this, the interest return is also cheaper in this money market. So the capacity of holding between organization as well as between traders is quite huge if you are going it on wholesale level. Okay, you just cannot buy shares, I mean single or double in that. Here in money market you have to buy it in bulk at a wholesale level. So when you are buying it in bulk, ultimately you will be having higher liquidities. Okay, next is your derivative market. Okay, in your derivative market, here a contract is signed between two parties or more than two parties. You don't have a specific number for it, but the minimum criteria is two parties. So ultimately, when a contract is signed between two or more parties, that depends on the financial security or whatever the asset that you are keeping it in that market. So the worth of the derivative is derived from your primary source of your security, which you are linking it to your secondary security, that is to your secondary market. So in simple words, your derivative market is nothing but here you are just trying to sell your asset to the other party. Okay, and also in this you have a contract between that is signed between two or more markets in exchange to your financial securities of your assets. And the last is your foreign exchange market. Okay, this is a market that we are basically dealing with currencies. Okay, as cash is your liquid asset, right? Similarly, many of the commercial organization, okay, many of the institutions around the globe, okay, they go on with digital thing. Okay, like this foreign exchange market, they have got highest liquidity of all markets. Okay, wherein they comprise the majority of their foreign exchange, because this foreign exchange value, it goes on changing at the very next moment. Whatever the value that you have it in 5 minutes may not be the same after 5 minutes. It goes on increasing, either increasing or decreasing. There is no proper constant value of it. And exactly we can determine also. Okay, for example, the value of the dollar is equal to, for example, 80 rupees. The next moment of time, we don't know whether it will get increase or it will get decrease. Okay, this is unpredictable. That ultimately depends on the economy of our country, how it goes on, right? So this is how the same thing we move on for financial foreign exchange market, where the highest liquidity of all markets around the globe, it just goes on changing at every moment of time. So these are some of the types of your financial market, that is stock market, over the counter market, bond
Bond.
market, money market, derivative market, and the
Oh,
next is your foreign exchange market. After this, we have functions of your financial market. Okay, you have nearly 4 functions of it that we'll try to discuss it in our next class. Okay, so any doubts in today's class? One by one, I'll just try to uh, share my PPT. Just if possible, try to take the screenshot of it. Okay, so this is one of the important concept in your block 2. Okay, either a question will be coming, explain in detail about financial market. If it is coming, you have to explain about capital market as well as money market.
yes, ma'am.
Okay, if specifically if it is asking capital market, then you have to go on with capital market. Okay, like when
Yes,
you start answering capital market, first give the definition of financial market and then write how many types of financial market is there.
4 times.
Okay,
Yes, ma'am.
capital market comes under the concept of primary market of your financial market. Okay,
Yes, ma'am.
then you can go on with describing about your capital market. Okay,
Yes, ma'am.
so
Yes.
from your block two, this is one of the important question wherein you can expect from financial markets. Okay, are you getting?
Yes, ma'am.
So capital market, when you are explaining, you have to give the definition of capital market, and then you have to explain what are the different types of capital market in this. Okay, how like what is the difference between your primary market and then your secondary market.
Madam, you share important questions also from block 1 to block
See,
2.
what I'm telling, whenever I'm trying to explain it, right, that time itself I'm telling you. So
Okay.
just make a star mark over there.
Okay.
Yes.
Sometimes it may happen, I may forget it, right? So while explaining only, I'm just trying to tell you which is the important question that you can expect in your final exam. Okay, no problem. At last also I'll tell you, but there might be some time restriction, right?
Yes, ma'am.
So for that purpose, whenever I'm taking a class, wherever I feel important, I'm just trying to tell you. So you just, put a star mark over there while I'm explaining.
Okay, ma'am.
Okay,
Okay,
madam.
fine. So one by one, I'll just try to change my PPT. If you want, you can just take a screenshot. Then in our tomorrow's class, we'll continue with functions of your primary market. This is also one of the important question, types of financial market. Primary and secondary are different and these are different. These are
Yes.
categories of financial market. So in detail, you try to explain it, stock market, over the counter market by giving one small example. The one that is related to stock, you call it as stock market. Over the counter market, you don't have any authority. This is a kind of a decentralized market wherein you don't have any hold in your hand. Bond market, wherein you are trying to sell your securities in lieu to your exchange of certificates. Money market, this is one of the safer market. Okay, the best example is your New York Stock Exchange. Derivative market, in this you have two parties. Okay, wherein a bond is signed between two parties. Foreign exchange market, again foreign exchange market. This is a real time market, you can say, wherein the price fluctuates over here. So you can write it in a detailed manner. Is that clear?
Yes, ma'am.
So in my tomorrow's class, I'll just continue with your
Functions of financial market.
functions of your financial market.
Market.
Okay, so I'll just try to wind up my class over here. Thank you all for attending my class.
Thank
Then
you,
again,
ma'am.
tomorrow
Thank you,
we'll
ma'am,
meet.
and you share PPT.
Sure, sure, definitely, Avinash. I'll share my PPT. Okay, then. Thank you.
Thank you, ma'am.
Thank you, ma'am.
Thank you.
In video, you are not coming, madam. You are simply.
My video, okay. What I'll do, I'll just open my mobile phone at the same time. Actually, in my laptop, there is no, camera. So I'll
Uh-huh.
just try to open my phone and I'll show you my video as well, okay?
Video, I didn't see you. So, some
Okay, fine.
previously one madam
Fine,
also explaining in a video only, like that.
fine.
Sharing
I'll
only.
just try to show it. Sometimes it might be network connectivity problem, right?
Yeah, yeah.
The bandwidth will be high if I open my camera. So
Okay.
I'll just try to use it from my different device, okay?
Mm.
Okay.
Once I should meet you, madam.
Once again, somebody is asking, Rosia is asking my phone number. I'll just try to share over here.
And meeting, I should meet you.
Definitely you can.
Mm.
What do you do?
I will working, madam.
Where?
You know, having own business. Garage is there, car service.
Okay, fine. Okay, Avinash, tomorrow we'll meet again, okay?
And tomorrow I may not be there. Some function is there tomorrow.
Okay, your friends are there now. You can just ask them if at all, if anything important is shared in the class.
Means YouTube link also it will be there, I think.
Sorry? Yes. Maybe you'll be getting it, right?
If any doubt cannot share me, I will contact you
Sure, definitely.
if you are free.
Yes, sure.
Yeah.
Okay, then. Thank
So
you.
capital market, share capital means what, madam?
Sorry?
Capital markets and share capital.
Share capital is a part of your capital market only.
Okay.
wherein you're just trying to exchange your shares to your investors, whoever is interested in taking it.
Hmm.
Okay.
Like financial
So,
marketing and some loans, long-term loans.
yes.
Some finance means like that only, no, ma'am. Like loan only, I think.
Ah,
Car loan,
I'll
bike
discuss.
like that.
I'll discuss elaborately tomorrow. Okay.
Hmm.
Okay.
Video are not coming. Your profile that one.
Sure, sure,
Is
definitely.
coming.
Tomorrow I'll view it.
You wait, madam.
Okay.
Previously,
Okay.
two subjects was video was came. He only not came.
Okay. Okay. Fine. I'll
Okay.
share it tomorrow.
Means your video, I didn't see you. That's it. Okay.